Welcome to my channel. I'm the cover call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields almost $70,000. Yes, the last video I was yielding about 61. I wasn't reinvesting that much, but I guess I got an increase in my payouts, which is a good thing. I love it. So I'm already about 70% there, an increase from 61 to almost 70 now. So yep, I'm getting about almost $6,000, or just about a little over $6,000 a month, compared to previous over $5,000 a month. So I'm getting there. So hopefully, I'll reach there mid 2026, or at least my goal is before 2026 ends. But anyways, I digress. I'm gonna be reaching my goal using mainly cover call ETFs. And once I reach my goal, leave me a comment where I should invest after that. Cover calls, growth stocks, single stocks. You let me know. Leave a comment. I'm open to everything. Before we get started, legal disclaimer: this content is for informational and educational purposes only, and it is not financial advice. I am not a financial advisor. I am not a licensed financial advisor or professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right. With that out of the way, today we will be reviewing Roundhill Investments. I I'm starting to get a little, I want to say I own an ETF which I'm building to $150,000 to $175,000 uh from Roundhill Investments. So I am very deep into one of their ETFs. But we gotta ask, right? So um they're not like one of my favorites like Neos, but I it's getting there, we gotta ask, is it the Wall Street Genius or Gimmick King? And I ask that because we're gonna do a deep dive into their innovative portfolio of thematic and income ETF as of late 2025. So what does that mean, right? So I'm invested in one of their income ETFs, but they have a lot of ETFs, and they're pumping out new ETFs all the time, right? And for the most part, it's thematic. What is thematic ETFs? What that is they're pumping ETFs that are trendy, memes, right? So they're just pumping out ETFs that are hype and what's popular right now. It might not be popular within 6 months. So, should we test those out? Should we invest in them? Should we take them serious, right? So again, let's do a deep dive in their ETFs, and then we can both come to a conclusion. I'll come to my conclusion, and at the end of the video, maybe you come to yours. All right, Roundhill by the numbers, verified November 2025. They have about 49 total ETFs. Again, I could be wrong. They have so many ETFs, I couldn't keep track if they pumping out new. So I just found whatever that they actually have listed and have data. Their total asset under management is just about 9 billion. They have 11 funds that are over 100 million in assets under management, and the largest ETF is MAGS, right? Almost 4 billion. And MAGS is just a ETF. I believe it was the first ETF that just held the MAG 7, and I think Roundhill was popular for that because they were the first ETF to do that. All right. The three pillars of Roundhill's strategy. Number one is the thematic growth pure play equities fund targeting high growth disruptive sectors like AI, and then they have their ETF chat, right? And then the metaverse and the Mag 7 Mags. And then two, they have their options income ETF strategies, right? The funds that sell call options on assets to generate high income. This includes MAGY on the Mag 7 and YBTC on Bitcoin. And yes, I own MAGY. That will be the position I am growing out right now to at least $150,000 to $175,000. My goal is for MAGY to pay me $1,000 per week. Okay. And third, trading vehicles, right? Tactical tools like the weekly pay series like WPAY, zero date expirations options, right? QDTE and the leverage funds MAGX, which WPAY is a leverage fund too. So I say trading vehicles because you might not want to stay in these ETFs for too long, right? They're in and out, get your profit or use the profits to build other positions. Okay. All right. Core portfolio, or they're going to be a thematic growth, right? These are the ETFs that you want to consider to build up on. Again, selection is based on your risk, right? So there is the meme ETF where if you want to get into the meme, right, there's a whole bunch of ETFs that in there that could grow. Again, a lot of these are gonna be based on trend, right? So the growth here is based on trend, right? The only one here I would say is that would be stable is the MAG 7, which is their biggest asset under management ETF anyways. So other than that, all of these others are more, what ifs. Could grow, could not grow, right? So just understand what this is. It's just ETFs that are created for the purpose of catching on the trend, whatever it's popular, whatever is growing at that time. So be aware of that. And then we have the core portfolio of the options income, right? So you want to build these as a core if you're trying to build income. And I'm going to talk about my MAGY, my MAG 7. I truly believe MAG 7 is going to be there. I have a joke of MAG 7 and chill, right? And I believe Netflix is part of MAG 7. Let me double check. Okay, it was part of my data was outdated. Okay, overloaded. So okay, so it's just Mag 7 and chill, no longer Mag Netflix and chill. Um, I believe Mag 7 is gonna always be there. These companies are just too big to fail. And companies always get rotated out of the Mag 7, right? So I would say it's impossible to fail. Um, it's basically the economy at this point, in my opinion. And of course, these are the other ETFs. And then we have trading vehicles, which I mentioned. These are the weekly payers, right? The leverage ETFs are these are the leverage 2x ETF. These are also WPAY is also leveraged, but I believe is 1.2x. Um, I'm I'm not sure. Let me double check on if yeah. So I believe most of these are leverage too. I've only done my big research on WPay because there was just too many funds. I couldn't get into all of it. I would have to do a video on each one and actually deep dive into their strategy and what they do. But I'm pretty sure it's straightforward with Tesla, Nvidia. I'm pretty sure it's just leveraged on the actual stock. So yeah, plus 15 more. I couldn't fit it all, and it was just a lot. So I put one of the most popular, WPay, on top because I know, and week is a big one. All right, deep dive WPay. Again, I couldn't do a deep dive on everything. Um, it was a lot. Roundhill investment. This video for me to put together was a little over about 4 or 5, maybe pushing 6 hours. All right, so a closer look at WPay reveals is Meta ETF that bundles all the other single stock weekly pay funds, right? So WPay is the funds of funds. It's just all bunched together, right? The WPay ETF is the fund of fund. It doesn't own stock. It tracks an index that hold other single stock weekly pay ETFs like Tesla, Nvidia, and it rebalances to an equal weight to each holding monthly. So it's synthetic, right? It doesn't actually, it creates uh what is it called, swaps, right? So in a bull market, when people are buying the holdings, your swaps are much more um valued in a way. And then when it's a bear market, you might, just as you can swing up with these leverage ETF, you can also swing down with these ETF. So a lot of people, they think it's a bull market and they got a FOMO in, but as soon as you get in and it goes downwards, you don't go down the same percentage as a regular non-leverage ETF. So you have to be aware of that, right? What comes after leverage is liquidation. So beware, right? As much as you can go to the moon, it will bring your ass down to the ground. All right, how WPAY's holding work, the real strategy. This is crucial because the weekly pay funds are not cover called funds, right? It's the leverage 1.2x. These funds use total return swaps, as I mentioned before, to get a 1.2x 120% leverage exposure to their stock, right? Nvidia aims for 120% of Nvidia's weekly return. They are built for bullish investors who don't want their money upside, who don't want their upside capped, right? So you want to dabble in this. You don't want to have this as your core. I would say dollar cost average if you can into leverage. I don't encourage leverage until you have completely built out a solid foundation in your portfolio. Okay, and especially if you're new. And then number two, the income, which is managed. These funds do not sell options for income. The weekly distribution is a managed payout calculated from the stock's volatility and recent performance. This is a ROC, return of capital, not a dividend, which a lot of people don't understand or don't know, right? They just think it's a payout, it's a dividend. It is not. How the other income ETF works. All right, so this is where I guess the genius versus the gimmick of the funds, of the option funds compare, right? Not weekly pay funds though. Strategy one, physical MAGY. The fund buys actual underlying ETFs. One of the core principle that how I choose um, my cover calls is that I don't want synthetic, I don't want swap, I don't want leverage. I want it to actually own the underlying. I want it to own good underlying, right? It buys MAGs and then sell call options against those shares to generate income. This is traditional physical backed cover call, which is, for me, my opinion, a little bit more reliable. It's able to grow, make profit, and it's buying good, quote unquote, companies, right? It's buying solid, profitable companies. And then strategy two, the synthetic. And for me personally, that's a big no-no, right? QDTE, the fund does not buy underlying stock. It buys long-dated flex call options to get synthetic exposure, and then sells short-dated um, zero. It basically expires within that week or that day, right? Call options to generate income, right? For me, that's a huge no-no. I don't want it. It has no place in my portfolio because it's too risky. I don't want any 0 day expiration options because you're either gonna, I don't want it to be either make it or break it, and I don't want my portfolio. I want to consistently build my portfolio up, or consistently get the same payout every month. That way, I know what I'm getting. I don't want to play that synthetic game risk. It just doesn't work for me. It's not gonna be part of my strategy. Top performers by key metrics. All right, the top three assets. Um, what, one mags, two chat, and three QDTE, and then top three by 1 year total return: chat, YBTC, and nerd. So again, sometimes gimmick works because you're a lot of people chase the hype, they chase the trend, they FOMO in, and then it works. So um just know when to get in and get out. Don't diamond hand anything. This is not for you to diamond hand, right? Get your money, get out, and then put it into a little bit more safer ETFs. Heads ahead, the bet versus the paycheck, right? Mags is the bet because it's a growth stock. Um, uh, the core trade-off: growth mags or income maggy. An investor generally can't have both. Okay, I say generally because you could have both, but why would you put so much into growth when you might as well stick with growth at that point and don't chase the income, right? If you're gonna do income, you're gonna do a paycheck, like dive into it, get compound it. Mags is the bet because it's growth. Its 1 year return is 43%, amazing. Annual return about 50%, and the yield is about 2%. Not so great, not for me, right? The investor gets all the upside and downside of the Mag 7, making money only if the stock goes up. That's paper gains. I want realized gains, which is why I chose MAGY, the paycheck, right? Total return is about 27%. We don't have an annual yet because I believe it came out it's fairly new. Came out September. I believe September of 2025. I had to double check on that. Distribution yield is 16 to 34%. 16 is the 12-month trailing, and they aim for a 34%. So hopefully we get there. The investor gets a large payout but sells most of the upside to get it. Yes, all cover calls, again, I'm going to say in every video, all cover call ETFs will have most of their upside capped because it's not growth. Now, would we love to chase a little bit of growth of while getting paid? Of course, there are plenty of cover call ETFs that will do that. All right. The MAGY caps gains but provides weekly income, which is my goal. All right, so I want to get paid that consistent weekly income while having the NAV stable, which has been shown it can do that for now. All right, the verdict: genius, gimmick, or warning. The genius is that Roundhill is a genius at marketing and product design. Absolutely, they know how to tailor to the customer. They know how to tailor to the younger generation, millennials and Gen Z. Right? They identify what investors want. The Mag 7 AI high yield and build a product for its instantly. The thematic funds as Mags Chat are true contenders for a growth portfolio. And then we have the gimmick, right? The gimmick is in the yield. Funds like MAGY and QDTE or not free money. They are income tools that sacrifice capital appreciation for cash flow. They are a gimmick if the investor expect growth, but a tool if they demand income, right? So that's the gimmick part, right? A lot of people see the big juicy yield and be like, yes, let me buy into it. I should be getting growth with it, and then they say, I'm getting the income, but what's happening with the stock price? And then the warning, right? The weekly pay funds, WPAY and TSOW, or different beasts, right? I personally, I'm okay with getting WPAY because I feel like I have enough experience and enough. I wouldn't put too much money into it, but if I were to get into it, I would put a small amount. I would dip my toes into it. I wouldn't do that right now just because I want to just focus on compounding my uh, MAGY ETF. But if I were to get into leverage, WPay is a good choice. It has been performing very well right now, of course, with the bull market, and it can only go higher type of mentality right now. WPay is showing very strong returns, but I would like to see what happens in a downward market and see how it also recovers. So they are leverage products. They are high risk tools suitable only for knowledgeable investors who can actively monitor their investments, right? So again, leverage, liquidation, they go hand in hand. You have to be careful with that because if a big crash happens, maybe something a little bit worse than COVID, it can also blow up your fund, right? So a 1.2x, if the market tanks 40-50%, that entire fund is gone. It's gonna get liquidated. The fund closes, right? It's done. It's gone. Goodbye. So you have to think about that too. All right, so essentially the fund gets margin called. All right, so what's the final verdict, right? The answer is both, right? It depends entirely on the product and you, the person, right? Genius, right? Their thematic funds, mags, chat are brilliant low-cost tools for prayer growth. They are true contenders. The gimmick, where I'm at, the options funds, MAGY and QDTE, or gimmicks only if an investor misunderstands them. They are income-generating tools, not growth funds. The gimmick is expecting to get both, right? And then warning, the weekly payers, right? The WPAY are not income funds at all. They are leverage trading tools in disguise. They are high risk product for active bullish traders, not for income investors. All right. So that's the end of it. You know, what's your verdict? Leave me your comment. Do you think these funds are genius or gimmick? Let me know your thoughts in the comments below, and don't forget to like and subscribe. I appreciate you guys. Thank you for watching. This took me a while because of how many stocks there was for Roundhill, and I wasn't sure if I was getting all of it. I couldn't fit everything. As you can see, they had so many ETFs. If you want me to do a deep dive and maybe you introduce me to a great ETF that I'm missing that I should be buying, let me know. I currently only have one weekly pair, which is MAGY. Right now I'm okay with the monthly because I feel like the monthly is a little bit more stable. I don't want to get greedy with the weekly and start diving into weekly stocks just because they pay weekly. I do care about the underlying and what they hold. So hopefully you guys found this interesting, educational, fun. Let me know what I should do in the next video. Let me know what ETFs I should be buying from Roundhill. Thanks for watching.